gentlemen, and welcome to the ET Now ICICI Prudential Value Investing Summit. Well, thank you so much, everyone, for taking time out and joining in for what is a very unique initiative in order to highlight the importance of value investing. And especially at a time when right now the stock markets are looking at a multi-year bull run. In fact, we have several interesting sessions that are lined up for you today. We also have a Q&A session where people in the audience will be able to ask questions to our esteemed panelists. So let's start off then by introducing and inviting ET-Now's Managing Editor, Mr. R. Sridharan, to deliver his welcome speech. Shri.
Thank you, Juan. Good morning, ladies and gentlemen. It's my pleasure to welcome you all to the ET Now ICICI Value Investing Summit. As India's most watched business news channel, ET Now is committed to educating its viewers on the power of equity investing. Most small investors are scared of investing in equities because they fear they will end up losing money. And to be sure, many of them do. That's precisely why equity ownership among Indian households is tragically low. According to recent RBI data, just 2% of financial savings of Indian households is in equity. It doesn't have to be so. Investing in stocks should be anything but a gamble. It cannot be a matter of chance. Investing ought to be about identifying the right stocks at the right price and with clear growth opportunities. Investing needs discipline and patience, and it doesn't matter if you're an experienced fund manager or a layman. Let me not take any more of your time. Sit back and enjoy. I have no doubts you're going to walk out of the room richer than what you did when you walked in first this morning. Thank you all.
Well, thank you, Shri. Let me invite on stage Mr. Nimesh Shah, who's the Managing Director and CEO of ICICI Prudential, to the stage. Under Nimesh's leadership, remember, ICICI Pru has experienced a remarkable turnaround in the fortunes and established itself as a leader in the mutual fund industry. So please go ahead, Nika.
Thank you, Juan. Good morning, and once again on behalf of ET Now and ICICI Prudential, thank you for joining us. So with that small opening remark, let me turn to Nimesh. Nimesh, the heart of value investing, I think, is a very simple concept. Buy low, sell high. Buy cheap. An Indian housewife knows this better than anyone else. Sasta lene ka. But in real life, it is a very difficult activity to implement.
It is difficult because you are actually doing exactly opposite of what the rest of the world is doing. It's a lonely activity because when the rest of the world, the price is set by the growth investors, right? If they are selling some sector, if they are selling the stocks, they are selling it out and you will be buying at the price which the growth investor has already set. So price is set by the growth investor. He has already set the price, he is selling it, you are buying it, and you are the lonely guy. So ability to tell people what has not worked in the past, that the time for value investing is when the past returns are not that good in that sector. That is the time to go and invest. So that has been a challenge.
So in value investing, past performance is no indication. That is why a mutual fund document says that past performance is no guarantee of future returns.
Correct. And in fact, value investing, sometimes I feel when it has not worked, when say that particular fund of, when value funds don't perform that well, the last 1 year, 2 years, that's the time to invest. Because you are essentially looking at 3 to 5 years. If you have the waiting time for 3 years, 5 years, ideally 5 years, then only you should get into investing in value. Otherwise, don't invest in value. That's what our...
That is the pitch.
That is the pitch.
Okay, so if I look at the global averages globally, and this is data which has been compiled by various agencies, which is 45% of the global investors are value investors globally. But India, that number is still in early teens. Why is that? Why is that India, we don't have true blue value investors? We have the oldest exchange in Asia, so equity is not a new culture for Indians.
This is like buying in a sale. Indians love buying in a sale, right? Every time there is a sale, we go and buy. So inherently, Indians love buying in a sale. But when it comes to stock, people love to buy when it becomes expensive. So that's the challenge. That's the conviction that we'll require to go out and tell people. It's a question of experience. I think this concept in India is set to come. Only 5 to 6% of, say, even in mutual funds industry, out of the 3,10,000 crores, pure value funds would be around 16,000 crores. So I feel that over a period of time, this concept is set to grow now.
My next question to you is that typically value investing works when there is fear, when there is panic, when there is an event risk, Value investing may not work in a bull market. We are in a bull market. Why are you propagating value investing now?
I am not propagating for 2 years. I think we are in the beginning of a bull market where 2015, according to us, is going to be a very interesting year. It's an investment year. If you see the last 10 years, except years like 2007, value investing does not work in a bubble market, right? But that it won't work, but that is the time to invest also in a value fund. 2007 could have been a good time to invest when the past performance. I started off that you should invest in a value fund when a past performance is not there. So this time when there is a bubble in the market, that time I would expect that your audience, which is watching it today, will be looking at value funds because they are relatively cheaper at that time. Value is not essentially buying cheap, right? Value is buying at a discount to the intrinsic value.
Okay.
So today it is our ability, my fund manager's ability to understand value with the next 3 years, the way the industry is going to span out, which are the sectors in the industry where where the fund manager believes that there will be sufficient amount of growth. So another aspect, if people believe that value and growth are completely two different concepts and one does not work with the other, they always work together. They are like, as Warren Buffett suggested, there is a joint at the hip, right? It has to work together. Value is always with the growth that is envisaged over next 3 years. That is where value will work today.
My final question to you is that the virtue of value investing is also patient investing. You have to wait it out. You could be lonely. But in today's day and age, when NAVs of mutual fund schemes are tracked not on a monthly basis but on a daily basis, and you judged on your performance, and that's how flows move, is it advisable to follow the path of value investing?
10 years history, credibility of the AMC, and the ability to take a contra call on a consistent basis we have delivered. So though NAVs have to be declared daily, a lot of mutual fund holdings from 1.5 years now is beyond 3 years. The average holding for our investor is now beyond 3 years. I think this year would be the takeoff year for value investing really today. And we are kicking off with this particular initiative where we want to go into the market and explain people that there is a whole area which Indians needs to focus more.
Ladies and gentlemen, let's now focus on the keynote address that I'm sure you all have been waiting for. I know I have with bated breath. Mr. Monish Pabrai needs very little introduction to fans of value investing. His Pabrai investment funds, which started in the year 1999, inspired by Warren Buffett's original 1950s firm Buffett Partnerships, has delivered annualized returns of more than 17% for 15 years now. And that's net to the fund's investors. Mr. Pabrai is in fact also the author of a book on value investing going by the name Dhando Investors, and I'm sure most of you have read it. Ladies and gentlemen, please put your hands together for Mr. Monish Pabrai, Managing Partner of Pabrai Investment Funds.
Thank you. Thank you for that warm introduction. So many of you have heard, you've heard the story of the man who invented the game of chess. And when he invented the game, the king of that region became a huge fan, and he became an addict and an ardent chess player. And he asked the inventor of the game to ask for any reward. And the inventor said, I don't want much. I just want you to, on the chessboard, put 1 grain of rice on the first square, and then 2 grains on the second square, and then 4 grains on the third square, and then keep doubling the grains as you go on every square. And when you fill up the chessboard up to the 64th square, that is all I'm looking for. And the king was kind of annoyed because he said, I wanted to give you all these great rewards, and all you want is a bunch of rice. And he said, yeah, that's all I want. So he tells his treasurer, measure out the rice for this guy and get him out of my court. And after a week, when the treasurer wasn't done yet, so the king asked, what's what's the problem? And the treasurer said that, we don't have the rice. And he said that not only do we not have the rice, we don't actually have that amount of rice on the planet. And so we just cannot fulfill the obligation. And I went back and actually calculated how much rice that might be. And it ends up that at present rice prices, it would be about $300 trillion. And $300 trillion is an interesting number because it is exactly just about the wealth of every man, woman, and child on the planet. So if you looked at US household wealth, it is about approximately $80 trillion. And I think global wealth is just around 300 trillion. And so that is the power of compounding. And that is why Einstein called it the eighth wonder of the world. And, I'm an engineer by training, and I hadn't gone to business school. And I heard about Warren Buffett for the first time in 1994, just about 20 years ago. And when I heard about him and I read the first couple of biographies that had been written on him, I was actually stunned because what Buffett had done is quite astounding. So at that time, I really had no knowledge of the world of investments. And when I looked at Buffett's track record, and at that time I could see a 44-year track record from 1950 to 1993, and over that 44-year period, he had compounded at 31% annualized. And 31% annualized means that you're basically moving to the next square on the chessboard in less than 3 years, like 2.6 years or something. And then when I calculated, the 44-year period, he was already at that time on the 18th square. And he didn't look like he was going to slow down or stop. And I said, my God, this guy is the wealthiest human on the planet and likely to continue to stay there for a while. And that's exactly what's happened. So from 1994 to 2014, we've gone another 20 years. And even though the sums have become larger and its compounding rate is lower in the last 20 than the previous 20, it's still north of 20% a year. And so Warren Buffett, even after having given away so many billions, is north of 70 billion net worth. And so that is the power of compounding. And that's why I think that this chessboard story and Einstein comments are so wonderful to keep in mind. In 94, I made a couple of observations, and I wasn't familiar with the hedge fund industry at the time. I was familiar with the mutual fund industry, and I couldn't find any mutual funds that had that sort of a track record then or even today. Warren Buffett's approach, which is so different, is he said that you're not buying a stock, you're buying a business. The stock market is there to serve you, not to instruct you. So never look at stock prices to tell you what's going on with the business, but really look at stock prices to serve you in the sense that if they are creating wide distortions between intrinsic value and the price of the stock, you can certainly look at that as a buying opportunity. And if that's not there, then the intrinsic value is approximating the market price and you own a stock, it's probably a good time to move on. And I had a notion that Buffett's approach was replicatable, and I didn't find very many people trying to replicate it. And so I decided to give it a try. I think the important thing is that you keep moving to the next square, because as you keep moving to the next square, the magic of compounding, the eighth wonder of the world, starts working for you. And so I was 30 years old at that time in 94, and I had a IT business. I actually sold some assets in the business, and after taxes and such, I was left with about $1 million. that I didn't really need. It was just an extra million in the bank. And in fact, it was my first million in the bank because we had started the company on credit cards. And so I thought, what if we put this million on the Buffett compounding engine, if you will? And I had a notion that if someone followed Buffett's approach to investing, and which means you make few bets, you make big bets, and they're infrequent bets. You think of stocks as a business, you buy them when they're on sale, you patiently wait for that value gap between market price and intrinsic value to close, and then you sell and move on to your next investment. So a million, if you go 30 years, that's 10 3-year periods. And 10 3-year periods is 2 to the power of 10. And 2 to the power of 10 is 1,024. And we don't care so much about the 24. We can forget about that. So 2 to the power of 10 becomes 1,000, which means that if you start with 1 crore, you're going to have 1,000 crores. And if you start with 1 million, you'd end up with 1 billion. And I thought that'd seemed like a very easy way to become a billionaire. And I also thought that, if I fell short, even fell short by 80%, that still wouldn't be such a bad result. 200 million was fine with me as well. It's been a wonderful journey for, I think it's been about 19 years now, and I hope it doesn't end in 11 years. I hope it continues.
Thank you so much for joining in, Mr. Pabra, and giving us all of that insightful and eye-opening information. But I'm sure everyone in the audience is also very eager to ask you lots of questions. And Nikunj will be helping to take forward that discussion.
Okay, so I'm going to I'm going to use my privilege here. Before I open it to the floor, I have a question for Monish. Monish, you're a computer geek. You've got degrees in engineering, you've got degrees in IT, and IT professional has become a value investor. That's very, very intriguing.
I think that one has to go a little further back. My father was an entrepreneur here in Mumbai, and he'd run a number of different businesses. And from the early teens, my brother and I, we used to actually be like his board of directors, because they were usually these businesses were having all sorts of problems. And so I felt like many times we were trying to figure out how to keep the business alive for one more day. Okay. And figure out how to run the cash flows for another day. And so I felt like, I think by the time I finished high school, I had finished many MBAs. Okay. And I didn't realize it at the time, but in investing, Warren Buffett has a wonderful quote. He says, "I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor." So if you've run a business before, it is a huge advantage to come in with that framework and become an investor. And so I actually found value investing quite natural because that investment, that business experience in the teen years, and also in running the IT business. And beyond that, Warren Buffett says that you want to invest in businesses and industries with a slow rate of change. Rapid change is the enemy of the investor.
Buffett historically has not been a big proponent of investing in commodities. He believes that commodities are cyclical. I like to focus on constant, pieces of business which grow constantly. But in your experience, you also invest in commodity.
Yeah, I mean, I think commodity businesses are perfectly fine to invest in. The key is that you want to be one of the lowest cost producers, or low. So if you look at quartiles of production costs, if you're in the first or second quartile, you're going to do fine. So I think that commodity businesses, which are low cost producers, bought at the right price, can be quite good.
I guess our viewers and the audience here is keen to know that how do you generate a fresh idea? I know you're a big fan of this checklist approach. So what does your checklist really contain? And how do you identify a good value business?
Yeah, the checklist doesn't help identify ideas. It just helps, I would say, vet them and help them. But I have no original ideas. I think almost everything in our portfolio is cloned from some other investor I admire. And the wonderful part of the business is I still get paid, even though I have no ideas. And I think in India you have the same requirements. In the US, we have these 13F requirements, filing requirements, which professional investors have to file once they cross, I think, over 100 million under management. And I think in India, there's a requirement once you go over 1%. I think the brokers have to disclose it. And so I think those are, if you can identify great investors in India and look at their portfolios and look at especially the ideas where they have the greatest conviction, then those portfolios will tend to do well.
So typically when you identify a stock idea, you have an entry point in mind, but what about your average holding period? What about your exit? Do you plan something when you're actually investing in a stock and an idea?
Yeah, typically what I do is before I make the investment, I'll run the checklist and of course do all the analysis, but in the end I write up typically a paragraph. It's usually no more than 5 or 6 sentences, which explains the thesis, which explains why I'm investing, what I think the intrinsic value of the business might be, and at what point we might sell, and what are we looking for. Most times I have a good idea of what intrinsic value is, and usually I'll go back every 3 months or 6 months and update that paragraph. So if you buy something that is within your circle of competence, by definition, you know what it's worth, because if you don't know what it's worth, it's not in your circle of competence. And if you know third grade math, you know what it's worth. You divide by 2, and if it's priced below that, so I typically am not interested in buying assets that are not priced at least half of what I think they're worth. And then we use our third grade math, divide by 2, and if it's less than that, we'll buy it. And then as it approaches full price, typically anything at 90% or more of intrinsic value, it's a candidate for sale.
Okay, we want to open to the floor, and Avan is there. She's going to take up the questions. For anyone has specific questions for Munish, the mic is just going to reach you. The mic is with the gentleman.
Hi Manish, thanks for being here and sharing your insights. I'm a student at Stanford and I was curious to get your insights on the global economy moving forward. So in particular, in light of the fact that the ruble's down 40%, Russia is expected to contract 5% next year. So what is 2015 going to be like for investors? Do you expect it to be a really choppy ride with the sanctions on Russia, Ukraine crisis, Iran sanctions, or is there a glimmer of hope or some positive outlook for 2015?
Whatever we have going on today, you can pick any time in history, and the world always has issues. I mean, it's just the nature of humanity. We've got all these things going on that you always have issues. So the best thing to do when you're investing is to focus on the micro, to focus on a specific business, and it is hard enough to just hone in on a particular business and try to extrapolate forward what happens to that business. So I generally think it is going to hurt investors more than it's going to help investors if you overdose on macro. I would say that most of those things are very hard to predict, and the best thing is to just not bother with predicting them. I would say this, I would say that, and I don't, hopefully it doesn't taint too much of my investing, but I have a view that the United States, I believe, is the emerging market. I think what I see is the country has so many strengths and is in such tremendous shape for a number of reasons that I actually think that next decade or two, it'll do incredibly well. I also think that there's a chance in India, there's a lot of expectations of Mr. Modi, and Modi ji has to be super Modi ji to fulfill those. But I think that some of those expectations are well founded. I think I'm I would say I would be bullish on India because for the first time, I think in our history as a country, we have a capitalist, an honest capitalist who's running the place. Indian government needs to do 2 or 3 things: get out of the way, focus on infrastructure, focus on education, and then let the people do their thing. And there's a good chance that in the next 10 or 15 years, we will look back in a decade or 2 and seen remarkable change in India. And if that change is in the direction that we expect it to be, I think everyone would be surprised with how conservative they were about the outlook for India.
Thanks for that. And Manish, you make it sound so easy: armchair investing, 3rd grade math, no using Excel. But on a serious note, it was certainly very thought-provoking and very insightful, as I'm sure everyone in the audience will agree.